Hi there, good afternoon and welcome. You're watching the Mutual Fund Corner. I'm Mangla Malu. With me is Sumaira Abdi. Like every Tuesday and Thursday, we answer all your mutual fund related queries. But before we do that, a look at the markets roaring for the frontline indices. If you take a look at the Sensex as well as the Nifty, in fact, the Nifty offered a dip of 40 points in the morning. From there, we've seen a sharp recovery of almost 120 odd points at the high point of the day. For all the frontline indices, the mid caps and the Nifty Bank, both of them are hitting triple centuries as we speak, with a high movement in terms of the advanced decline ratio. In fact, from the start of this month itself, March, that is just 2 trading sessions, the mid-caps have outperformed the frontline indices by a factor of 3. 1.2% for the Nifty, 3.6% for the mid-cap index. Sumaira, not bad.
Not bad. I heard you call the frontline indices having a roaring up move. I wonder what's the adjective you'll use for in the broader market.
Rip-roaring, if you must.
Okay, so let's get started. First up, our top stories. Mid-caps take a giant leap. The index outperforms frontliners by a huge margin on attractive valuations and hopes of return of the NDA government.
Frontline indices rise but they are overshadowed by the mid-cap index. Tata Motors, the big index gainer. Heavyweights, Infosys and L&T under pressure.
February auto sales continue to disappoint. The Federation of Automobile Dealers Association says dealers are stuck with 2 months of inventories for two-wheelers and 45 days for passenger vehicles.
Indian exports lose to generalized system of preferences advantage in 60 days. Indian Commerce Secretary Anup Vadhavan disagrees with the US view that Indian tariffs are too high, says it is consistent with WTO commitments.
And China projects lower growth target of 6 to 6.5% in 2019 compared to 6.6% last year, marking the slowest pace of growth in 30 years. All right, those are all the top stories, but let's talk about mutual funds. Anurag Seth, the head of global wealth management at Quant, joins in to answer all the queries that are coming in. Hi, Anurag. Good afternoon. Good to see you in here. And let's delve right into some of the questions that are coming in. Purushotta MBG has written to us from Karnataka. He wants to know about the CPSC ETF and the Bharat 22. So he's 60 years old. He's still working, so not retired yet. I think he's invested in both, though I'm not sure what place they have in the overall portfolio. Okay. So therefore, just looking at these two individually, the funds, what would you advise?
See, exchange trading funds are just another mutual funds that are listed and traded on 6 stock exchanges. On CPSC ETF, it is confined mostly to 80% of the holding is on NTPC, Oil India, Coal India. So to that extent, it's not that diversified. Bharat 22 ETF gives you that kind of diversification. It's again an ETF platform which is diversified into across 22 stocks. So between the two, I would suggest to look at a Bharat 22 ETF, which is an exchange traded platform, and it gives you a kind of diversification which a CPSC doesn't give now.
All right, fair point there. We have another query coming in. Deep San calls us from Bengaluru. He has multiple investments in mutual funds, wants us to assess his portfolio. Deep, tell us.
Hi, thank you for putting me online. So I did send a list, but I can read it out.
Yep.
The goal is to, in a span of 9 to 10 years, I want to accumulate around over 30 to 40 lakhs.
Okay.
And then plus over another 6 years, I wanted to see the growth go up to around another 40 lakhs.
All right.
So should I list out the investments which are...
No, we do have the list which is on our screens. Also, we'll read it out for the benefit of our viewers who would probably be invested in the same funds and would have similar return expectations as well. So he's got Aditya Birla Sun Life Equity Savings, Axis Blue Chip, Axis Long Term Equity, Canara Robeco Equity Tax Saver Regular Fund, and then he's got Franklin India Prima, HDFC Small Cap, HDFC Top 100, ICICI Approved Blue Chip, Kotak Emerging Equity, Mirai Asset India Equity, Parag Parikh Long Term Equity and Reliance Large Cap. So first up, he's got 12 funds where he's diversified his money into. How much diversification is too much diversification?
See, anyway, compared to what you invest into direct equity and compared to mutual fund gives you that kind of diversification.
Right.
Each scheme itself would be 30-40 stocks. So once you are invested into 12 schemes of mutual fund, you have over-diversified. So I don't know whether you will need 12 schemes. So I think my first advice would be to consolidate into a depending on what your age profile is, look at a large cap and a mid cap portfolio or a mix of a multi cap portfolio. So one is diversification, which is over diversified, to then consolidate the list of mutual funds. And then probably you can look at SIPs. You're anyway probably doing an SIP, continue that. And then you have a very good option in terms of top up. Every time when you do an SIP, every year when you get an increment, it's an initial top up that you need to subscribe for while you are subscribing for an SIP. So it's a very good option where every year your top up happens on a SIP automatically. You don't need to do anything. And your list of schemes are okay. Once you consolidate, I think your SIP will give you that kind of copper that you require over a different time horizons.
So the three goals that he has, which is 25 lakhs by 2028, 85 lakhs by 2035, 30 lakhs by 2037. Is he on track to meet all of his goals?
I think he's more or less on track. So even if you take a 10% CAGR on the schemes that are invested and considering a 20,000 SIP that he does every month, all the parameters that he has suggested over the time frame that he has, I think he meets his goals. The only my advice is to not to consolidate and then do a top up, which is I don't know whether he has done a subscribe to the top up facility or not.
Okay, Deep, anything else we can help you with?
Yeah, at the moment, no. So to takeaway is to consolidate. That's the takeaway here.
Yeah, so basically 12 schemes is too many schemes.
Sure. Yeah, I got this.
Okay.
So is there anything where I need to tone down? Which are the ones I need to knock off?
Yeah, so we should have probably told him that. So from these 12, Anurag, which are the ones that he basically stops the SIP, and where does he move that money?
I think once you see I don't know what was the period of your SIP when you started. I think you started 3 months back.
Yeah, 3 months.
3 months back. So I think once you see over a year or 2 years, continue it for some time, and then probably when you see a considerable return on a portfolio, then that is the time you need to consolidate. Look at getting out of small cap and get into a multi-cap scheme of things, which will give you a longer term horizon on an SIP.
All right. That's from Tamil Nadu. Hi, ma'am. Good afternoon. How can we help you?
Hello, ma'am. First of all, I would like to thank you for giving a special series on the mutual fund beginner's guide. That is wonderful.
Thank you.
Helping many viewers like me who are very young and who don't know anything about mutual funds.
I'm so glad. I'm so glad, Janali. Thanks so much.
Ma'am, I have sent my portfolio to you.
Okay. I know. So you have 4 funds, right?
Yeah.
Go ahead.
So now I'm planning to add an ETF. Like when I sent the query long back, so I started with Reliance ETF Junior Bs. I'm investing 5,000 every Thursday because of this Nifty option expiry. So I'm doing like 5,000 every
So that's 20,000 a month.
Yeah. So I can do it for 20-25 years. So is it a good thing to do it every week, or should I just have it like a monthly expiry thing? Like, at the end of the series, there'll be a date where I can go and invest 20,000 at once. Will that be a good idea, or is it good to play the volatility every Thursday?
Okay.
What's that?
And
also
your overall goal is
just for wealth creation for 20-25 years.
Okay, which you want to collect a minimum of 2 crores, right?
Yeah.
Okay. And, I'm also curious, in your query, you have written that you're a conservative investor. Any reason why your risk profile is so conservative?
Ma'am, because I invested when I was 19 in BSP small cap. I made a lot of money, last 3 years back, small cap index was in the peak. Then I moved out the money, my NAV was falling, so I kind of quit DSP small cap and I moved that money to DSP equity opportunities because, the small cap index was just down 30%. So I just thought I would play with large and mid cap funds. So as DSP equity is blend of both large and mid cap, I moved it to mid cap. I didn't want to step into small cap again and, I should correctly know the entry and exit point, which I'm not aware of. So I thought
Okay.
I play with large and mid cap funds.
Okay, so Janali, my two bits, of course, is that, mutual funds and stocks are different animals, and therefore what's necessarily true for stocks may not be true for mutual funds and vice versa. These are essentially, long-term wealth creators. But Anurag, over to you. So since she sent in a query, she's added another 20,000 rupees a month in the Reliance Junior Bees. So what are your thoughts?
So my two bits, one is your equity, you're all 100% equity invested. So not sure on why do you term yourself as a conservative investor. You need to have a mix of equity and debt both. So try to add a little debt on a portfolio which is required to meet your any short term or a medium term or a little longer term liquidity needs. Second, on your you have a good stock selection, so continue. Third, on your query on investing 5,000 every Thursday, so I think continue with it. 20,000 rupees every month is a good amount to be built on for the corpus that you are looking at. My only advice is never go, stop the portfolio of what you have already started. So I think you have started on building up a small cap index 2 years back and then probably lost out in terms of seeing the NAVs dropping. Because if you keep on doing, and no one is able to perfectly time the market. So if you need to then continue, you need to take advantage of the situation that we are into. We need to build corpus on the year that where the indices fall 10, 20, 50% or increase the allocation during that time. So otherwise, all is well. You are just 25 years of age, as what I understand. So it's a good time to build a little aggressive portfolio, but also do look at a debt as a certain option to meet your immediate or medium-term goals.
All right, fair point there. So I hope that answers your question. With that, we have another query coming in from Sri Ram Kumar. He writes to us from Andhra Pradesh, wants to know his view on the ABSL Manufacturing Equity Fund. He says he invested in this 2 years ago when the NFO was launched. So a couple of questions there, from an investor perspective. First, investing in NFOs, is that a good idea? Secondly, sectoral NFOs or sectoral funds, is that a good idea as well? So it is the ABSL Manufacturing Equity Fund, which is a sector fund. And secondly, it was a new fund offer.
So I think that ABSL was Manufacturing Equity Fund was launched in 2016 in line with government big push on Make in India program. I have no clue in terms of overall portfolio and whether it is already a diversified portfolio and he wanted a sector view or a sector going by what the government had to offer in Make in India. There is a push. It will take time. The portfolio is well constructed. Give it time, I think another couple of years, but please have any sector view. You need to ride that sector for at least 3 to 5 years for it to make any meaningful return on a portfolio. Don't look at a short term or a 2-year window. It's a sector call which may not play out in a certain time, but at certain times may play out well beyond anyone's returns and all. So to that extent, hold it. The overall composition is good. I don't have a clue on the overall portfolio, but if you are over diversified and if you are into large cap and mid cap, then a certain sector view is good to have.
All right, Anurag Seth, thanks very much for making the trek down to our studios, and thanks very much for answering all the queries as well. All right, on that note, we'll take a very quick break. Up next, lots more market talk lined up. We'll also get you a little bit about the future for a lot of these power producers. Do stay tuned.